Did you know that the Indian bond market is worth $2 trillion or that it has grown 15% year on year over last 10 years? Large financial institutions, corporate treasuries and family offices are the largest investors in these bonds. This is because they offer low risk, especially on bonds with an A+ rating. In fact, even in the COVID impacted financial year 21, the default rate of bonds was just 2%. Secondly, they give 8 to 11% returns versus just 4 to 5% returns offered by fixed deposits. And they are typically have short tenures of between 15 to 36 months. Wondering why this isn't part of your portfolio then? Before we get into that, let's first understand what a bond is. A bond is a financial instrument that enables companies or the government to raise funds in the form of debt from investors. The borrower uses the funds for its operations or capex, while the investors earn interest on his or her investment. Despite its many advantages, individual investors like you and me have found it hard to invest in this financial asset. This is mostly due to the three reasons: high ticket sizes, limited access, and lack of information. GRIP is changing that by giving you the access to curated corporate bonds at just ₹10,000. Here are some of the features of the bonds you can invest in via GRIP. Secured corporate bonds backed by collateral, rated A or above by reputed agencies like CRISIL or ICRA, offering you 8 to 11% yield to maturity, listed on NSE, BSE and held in your Demat account for exit. Visit gripinvest.in to learn more and get started. It is important to understand that such investments do not guarantee that the investor will make money or indicate that the investment is risk-free. User discretion is advised in selecting the right investment. GRIP does not provide investment, tax or legal advice to buy or sell recommendations.